Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. A new survey finds 81% of Gen Z says the economy is either bad or, quote, terrible. This matches the worst results of the 2008 crisis and the 1970s stagflation. And it's weird considering jobs are doing just fine at 4.3% unemployment, historically low, while the Atlanta Fed says GDP is running currently at 4% growth, which is historically high. So why are young people so miserable? 3 things: wages not keeping up with inflation, soaring college debt, and housing that costs so much they gotta crash with mom or share ramen with the roommates, with a new fear unlocked from AI and jobs. The surveys from Generation Lab, which found 81% of Americans age 18 to 34 rate the economy as bad or terrible, with just 2% saying it's, quote, excellent. The numbers are identical by gender and race, except blacks, where more say it's bad, but much more say it's excellent, 2.5 times more than whites. Now, as you'd expect, there's a huge difference by political party, with Republicans optimistic and Democrats peering over the ledge. Still, setting aside politics, the pain is real, unlike the sociology jobs they were expecting. Wages hit a wall under Joe Biden with zero growth while prices jumped 25 to 30%. Trump's second term is back to growth thanks to tax cuts, deregulation, and deportations. But that is a big hole to jump out of, and it's not close to keeping up with housing, which got a 1-2 punch of Bidenflation plus Powell's rate hikes, which together doubled the median mortgage to nearly $2,200 per month. That also drives up the salary you need to qualify for a mortgage, which just hit $112,000 according to Redfin. That's a problem for Gen Z since their median income is $45,000. So even with 2 incomes, just 1 in 5 Gen Z can afford a house at the prime age to start a family. In fact, 1 in 3 Gen Z are living with their parents, which is Great Depression levels. The average first-time homebuyer just passed 40 years old, which is a bit long in the tooth to be starting a family. The fertility rate, children per woman, just hit the lowest in American history at 1.7. And then there's college. The average Gen Z grad is carrying over $40,000, double if they got that master's. Now, that was not a problem when even crap degrees paid, but the college wage premium is crashing, down by half since 1960. In fact, the majority of recent grads are working in jobs that don't require a degree, which makes for very expensive wall art. That's set to accelerate as AI gobbles up the entry-level cubicle jobs, which used to be the safety net for gender studies and history degrees, replaced with blue-collar jobs, many ironically building the data centers and energy infrastructure that's said to wipe out the college jobs. So as next, costs will get worse. Federal spending and the Federal Reserve are not going anywhere, and AI will continue coming for the cushy cubicle jobs. But if Gen Z reskills for the jobs that actually exist, rather than the jobs they wish existed, they will do great. So skilled trades, engineering, medicine, AI-adjacent skills, a lot that involves unlearning their entire government-provided education, both the useless skills and the learned helplessness. In short, the boomers got it for free, Gen X got it close to free, Gen Z is gonna have to work for it. European voters are finally waking up to mass migration so late the hotel charts them another night, with polls showing soaring voter support for mass deportation, a sad day for Europe's censorship industrial complex that bolted the suggestion box to police vans but still cannot throw voters in prison fast enough to keep the rest in the dark. Last week, French pollster IFOP released a survey finding 70% of French voters with an opinion think the French people are being, quote, replaced by migrants, with 90% saying that is a bad thing. This echoes other recent polls with 70% of British, 80% of Spanish, 81% of German saying immigration is too high. In fact, a recent poll of German gays found the most popular party is the right-wing mass deportation AfD. Now, you'd think at 70 or 80%, governments would be jumping to ship them back to Syria, but of course, European countries are going the other direction. Spain's left-wing government recently drove through mass amnesty for up to 1.5 million illegals. That's about 12 million in U.S. population terms. Enough that the right populists in next-door France are threatening to build a border wall. Italy, allegedly run by a right-wing populist, just handed out 500,000 work visas under pressure from big Italian business who loves what migrants do to wages. But some Europeans are waking up, starting with, of all places, Scandinavia. Sweden just tightened citizenship requirements to exclude anybody who ever took welfare or committed a crime, while requiring fluency in the Swedish language, which is currently at threat of extinction due to mass migration. Denmark is deporting any criminal, charging migrants for the cost of deportation, a grand idea. Finland is cracking down on asylum, overdue considering so-called refugees who vacation in their home country they claim is too dangerous to be deported to. So the background here is, for decades, left-wing judges in Europe have interpreted the long-standing European Convention on Human Rights to ban any deportations to dangerous countries. Just like Japan having to take anybody from Detroit or Baltimore. It also bans deportations where the person has family in Europe, so if only one of them rape, all of them get to stay. They can't be deported if they have a serious medical condition, so every sick third worlder is Europe's problem. If they've been in Europe for a long time, the judges call it undue burden, or if their home country doesn't take them. Many don't, since migrant remittances make up a huge chunk of the economy in Africa. Put it together, and it's hard to deport anybody. Now, a group of 9 mostly Eastern European countries are trying to fix this, which should be easy considering voters favor it by 70 to 80%. Alas, Europe's left knows illegals are the replacement voters. The Spain amnesty, one senior official said, quote, "I wish for replacement theory. I wish we could sweep this country of fascists and racists replaced with migrants." Worse, third worlders already make up 1/5 of voters in countries like Britain and Germany, close to 1/4 in France or Netherlands, almost 1/3 in Belgium, meaning you need 60 to 70% of native voters to win, which is tough when media and education in Europe are captured by the left, fortified by weaponized hate speech laws. So as next, European voters are done with mass migration. Most of their governments are still fighting the voters, but cracks are showing. Europe's left will fight with everything they got, but they're up against migrants who commit crimes at 10 times native levels and trillions in welfare costs that even the censorship can't hide. A word from our sponsor. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington. The inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold, paid in more ounces of gold. You retain ownership of real, allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada and they're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. Are the days numbered for the Human Resources Department, that crusher of excellence, spawner of pronoun police, handmaiden of Leviathan? Last week, X was positively electric with news that once mighty Silicon Valley darling Bolt laid off its entire HR department, saying it, quote, created problems that didn't exist. Shockingly, everything got better. Now, this follows Elon Musk famously nuking the Twitter HR department and also finding less is more, certainly when it comes to the HR goblins. In Bolt's case, the company had gone from $11 billion valuation to just $300 million, 97% off, as the culture went from sprightly startup to HR compliance hell. The founder returned to pulling Elon, firing a third of the company and replacing HR with a lean and mean people's ops limited to benefits and payroll. Managers were empowered to resolve issues without involving HR, and he jettisoned the now mandatory Fortune 500 ideological commissar that imposes cohesion-crushing diversity, manufactures grievances, and acts as a shadow management, undermining actual managers whose job is to get stuff done instead of diversity engineering and hall monitoring with wrongthink. The CEO positively gushed, saying the culture instantly flipped to its mission-driven startup roots with less bureaucracy and nimble decisions. Grievances out, performance is in. So the background is corporate HR has metastasized into an $88 billion tapeworm, contributing to administrative bloat that costs up to $3 trillion in lost output. That's about $10,000 in lost wages per worker. Despite left-wing academics desperately trying to find DEI wins, research shows pretty much everything corporate HR does is catastrophic to performance and employee motivation. One study found choosing teams by race dramatically lowers performance. They spend most of their time getting on the same page instead of doing the work. Turnover from diversity hires alone costs $64 billion a year. That's not including the damage they did while they remained employed with lawsuit armor. One study of 829 firms found diversity training reduces women and minorities in management. Presumably, it leads to bad hires who have to be replaced fast. Another found diversity training has zero impact on bias, but strongly reduces employee trust. People are walking on eggshells, which makes them less likely to collaborate with diverse colleagues. The workflow itself becomes less diverse. One major study found negative ROI to training programs. They make employees worse, with nearly all positive effects fading within 24 hours. These sum to a one-third drop in productivity, according to the Council of Economic Advisors. And then the gold standard companies that implement ESG underperform by 50 to 75%. One sample by Kiplinger found just 4.3% stock returns versus 16% for the entire S&P 500. That's equivalent to lighting half to three-quarters of the company on fire for diversity programs that apparently make workers less diverse. So as six, HR will not go without a fight. Diversity experts making $200 a year to police pronouns will burn it down with lawsuits before they go drive for Uber. But it's hard to argue with a 50 to 75% reduction in stock performance when corporate boards have a legal duty to maximize shareholder returns. So far, it's just the companies with 97% stock crashes or Elon Musk taking over, but every other corporation is one shareholder lawsuit away from flushing the entire HR parasite. Is the second richest man in the world turning into the next Elon? In an interview last week, Jeff Bezos of Amazon went full populist, arguing to slash government spending, government control, and end all taxes for everybody under $75,000. He praised President Trump as, quote, mature and disciplined, framing support for the president as being, quote, on the side of America, and giving a full-throated endorsement of capitalism versus socialism. Now, Bezos has been moving this direction for a while. He was rabidly anti-Trump in his first term, but has since warmed not just to Trump, but to populism. He already moved to Florida for the taxes last year. He announced the Washington Post, which he owns, would be henceforth advocating, quote, free markets and individual liberties, as opposed to the communist deep state the Post used to advocate. He infuriated its liberal readers by refusing to endorse anybody in the 2024 election, which his readers read as a rebuke to Kamala. Now, this is all risky in Silicon Valley, where saying nice things about Trump can end your career and certainly ends the dinner party invites, but then being worth $250 billion gives you some leeway. And it matters because Elon Musk has done more than Congress, second only to Trump, for markets and free expression. It'd be splendid to have another cook in that kitchen. Bezos kicked off his interview by correctly noting that we've got two economies. Some call it a K-shaped economy with lots of people doing great, but millions suffering. But the kicker is, unlike socialists who want more government control and more taxes, Bezos wants less, starting with ending taxes on anybody making less than $75,000 a year, which would cost shockingly little, just 3% of federal revenue. He rejects hiking taxes on billionaires to cover it, as you'd expect, saying the government has a spending problem, not a revenue problem. And then the other half, government control and regulations. Bezos cited housing, where federal policy drives up prices with subsidies for mortgages while strangling supply with zoning and building regulations. And education, where he noted that New York schools spend $44,000 per student, yet half would require remedial reading and math if they were to go to college. Finally, crony capitalism. Bezos cited the 10,000-page-long tax code lovingly bought by corporate lobbyists and the billions Washington hands to corporations. He didn't get into the NGO industrial complex that siphons your life savings to left-wing rioters and clearing centers, but he did note that for-profit businesses do much more for the world than charities. After all, to build a successful business, you have to make people's lives better, whether it's McDonald's, Walmart, Amazon, SpaceX. But to build a successful charity, you just have to grab enough money and not fix the problem. That would end the donations. So as next, most of my listeners will not be surprised by anything Bezos said, but it's great to see the Elon bundle spread: free enterprise, small government, less corruption, and less government control. Dozens of billionaires, many formerly left-wing, have now come on side, including internet pioneer Mark Andreessen, who is terrified by government control of AI, Larry Ellison, who just bought Paramount and CNBC, and a dozen others who worry more about the economy than pronouns. Even Mark Zuckerberg seems like he's waiting for his wife's permission to hang out with Trump. We'll see if Bezos gets as hands-on as Elon, but it's encouraging that billionaires are finally turning against the communists who would hang them from a light post. A word from our sponsor. Stocks and even gold are all over the place. If you're ready to diversify, Abundant Minds makes Bitcoin mining simple, transparent, and human. You can deduct every penny thanks to Trump's big beautiful bill. It's a 401k for Bitcoin mining. Founded by husband-wife team Bo and Christine Marie Turner after losing $500,000 to broken promises in the mining industry, Abundant Minds was built to protect investors. You own the machines, and they make it turnkey with hosting in their facilities in Oregon. Pricing is clear with one flat monthly fee and no surprises, and they guarantee uptime so you keep earning day in, day out. If you want easy diversification without pressure, learn more at abundantminds.com/Peter to get some of your first Bitcoin mine for free as a gift to my audience. The biggest risk in Bitcoin isn't volatility, it is custody. Because Bitcoin removes the safety net, there is no bank to call, no reset button if something goes wrong. The reality is, most people are not properly set up. They hold Bitcoin but rely on exchanges, incomplete wallet setups, and have no real plan for privacy or inheritance. This is exactly what the Bitcoin way solves. They help you move from exposure to actual ownership, self-custody done right, privacy, inheritance, even running your own node, all set up with you step by step. They never touch your Bitcoin. They're your support team. Go to thebitcoinway.com/Peter to book a free call and go from where you are today to a much stronger setup. Now back to our show. Is the Iran war telling us our economy is broken? This has been a very weird war for markets, breaking the century-long rule that war is bad for stocks, good for bonds, and rocket fuel for gold. Instead, since America started rocking the Casbah, stocks rule, bonds drool, gold got thrown off a roof. So what changed, and should we be worried? When the Iran war kicked off, Wall Street predicted a 1970s disaster. When stocks dropped by half, inflation took off into the double digits, and GDP plunged, the dreaded stagflation that turned gold into the go-to late-night infomercial. Analysts called Iran, quote, the worst nightmare we thought could ever happen, incomparably worse than any oil shock in history. Reuters' poll of analysts predicted $150 oil, and unnamed Saudi officials said 180. Option markets said 200 or 240 oil. Longtime markets guru Ed Yardeni warned of a stock market meltdown. Bond guru Mohammed El-Erian warned of, quote, stagflation gripping the entire world economy. Moody's Analytics pegged 50% odds of a recession. Their script was the 1970s oil crisis when stocks did plunge by half, bonds held up with 3% gains, and gold positively sang up 70%. What turns out every bit of that was wrong. 3 months into the war, the S&P is not down by half. It's up 8.5%, which is 40% annualized. The long bond is actually down, annualized 20%. Gold is down 12%, annualized 50%. The Wall Street Journal was mystified, writing, quote, "It's hard to overstate just how unusual this is." So what changed? The first difference is oil did not get hit nearly as hard as expected. We're at 100, not 240. This is because new drilling, above all in America, and a collapse in Asian demand, above all in China, means fully 3/4 of the interrupted supply was effectively canceled. Either new drilling or less is being used. But the other reason is the stock market in 2026 is not the market in the 1970s. Namely, AI and tech are the stock market, and frankly, they don't give a damn about Iran. To illustrate, the 1970s tech was 5% of the market, but almost half was oil-sensitive sectors, industrials, utilities, materials, manufacturing. Today, tech is half the S&P and 70% of the NASDAQ, while oil-sensitive is less than a fifth. Healthcare and financials make up the rest. So in the 70s, we were deeply dependent on oil we did not have. Today, we don't need oil, but we're swimming in it, exporting millions of additional barrels. Put it together, and recession risk is actually lower than when the war started. According to prediction market Kalshi, we were at 22% odds of a recession this year before the war. Now we're down to 17. Meanwhile, the volatility index, Wall Street's fear gauge, is also lower than when the war started, even though oil futures say oil will stay high into 2027. Now, this all leaves one final mystery: why bonds and gold are sucking. And the reason is in the 1970s, fear dominated both, so-called safe haven demand. But today, the Fed dominates, namely fears the Fed will panic hike on oil prices, which hurts bonds and guts gold since higher yields tempt gold bugs into paper. So it's next. For better or worse, the Iran war showed our economy is no longer made of stuff you can drop on your foot. It's made of tech. More important, it reinforced the pattern since COVID that reality no longer matters. The Fed matters. Things go bad, they'll shoot money till everything goes up. That was COVID. And in wartime, markets don't care about the bombs or the oil. They care about the Fed. That's not healthy, but it's reality. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.